Take it from there.
I'm taking.
Good morning to everyone. So imagine yourself keeping two legs, one on this boat and one on the other. And your objective is to sail the boat to the other side of the lake. Honorable judges, members of the CA family, and my dear friends, the topic for today is consolidation of financial statements in comparison with the Companies Act along with the accounting standards. Now, the beauty of the visual is that it would be really pleasant to the eye if both the boats go together. My meaning is that it is not feasible to find out the differences, but wherein I must say that the topic should be Companies Act along with the accounting standards. Because we all know that
For
the
me,
laws
I mean,
are
for us, it
designed
was quite
in
normal and
mind
audible.
to make sure that
Because of the distance,
stakeholders,
maybe even the
this
people
interest
could hear
is well
it, as far as I it
and
was
that
not
is
too
the key
long.
objective that should be
But the
done.
content was superb.
Okay, done.
I loved the content.
I'm going to tell you three things.
Actually,
One is,
the
what
judge
does
was
the Companies
smiling.
Act say and what does the
The
accounting
judge was
standards say?
smiling when you were speaking.
What is the plan of
I mean,
action that
agreeing
the
with
client
your
or the companies need to follow in order to comply with the Companies Act and the accounting standards? And thirdly, which is the best part in my most honest opinion, what value addition as chartered accountants and students we can give to our clients. Alright? So the first part over here is the legislation. Now the thin line of difference between the Companies Act and the accounting standards is that the Companies Act only highlight eligibility for those companies to give the consolidated financial statements. Now what does this say? According to section 129 of the Companies Act 2013, a parent company having 50% or more shares in a child company, which is a definition of a subsidiary company, will have to perform consolidated a CFS, or a company having 20% of interest by virtue of shares or decision-making rights under an agreement, which is a definition of an associate company, will have to perform CFS, or if two companies get together for a common business transaction, which is nothing but a joint venture, then those both companies will have to give the CFS. What it says next is that any listed company which is preparing the CFS under IFRS will have to again continue the CFS. The Companies Act, the first time over here, has identified IFRS as a reporting framework. Thirdly, unlisted companies also need to prepare CFS along with its standalone financial statements. So the Companies Act has not spread even the private limited companies that we have. So therefore, we have companies like Flipkart who is holding around 49% to 50% of shares in WS Retail, which makes it as a subsidiary and as an associate company. So therefore, Flipkart will be making a consolidated financial statements of
WS
Retail and WS Retail here. Now, what does the accounting standard say? There has been no change in the accounting standards. AS 21, AS 23, and AS 27. AS 21 just gives the methodology of preparing consolidated financial statements. AS 23 gives the methodology for reporting the interest that a parent company has in an associate company, as defined earlier. And AS 27 gives a methodology for reporting the interest that joint venture companies have with each other. That is the only thin line of difference. So, along with the Companies Act and along with the accounting standards, we have to consolidate the financial reports for a better stakeholder transparency. Now, the next part is the plan of action, what the client has to do in order to comply, because the compliances, the penalties are very strict. First of all, companies need to assess their holding structure and legal line. In other words, they need to get a clear picture as to where their having shares. Companies like Tata Sons, and Birla, they are companies everywhere all over the world, and they all become eligible for CFS. The first step is have a clear picture of where your shares are going. Second thing is assess the impact of tax and any other regulatory requirements that will make a change in your district. Thirdly, set up a CFS reporting function in the company so that this separate team will only be bothered of compliance with the consolidated financial statements. Fourthly, if your company is eligible for indirect reporting, you have to have a CFS team even for indirect reporting as well. This is a very small kind of action that the companies need to follow. But now comes the juicy part, in my opinion, which is what value addition we can add to companies so that they comply. Right? So the first one is we as CAs, we are experts in terms of auditing and accounting. Since we are good at auditing, we know how to find a mistake. And we charge for telling our client where the mistake is and how to rectify them. So therefore, the most common sense point of view would be that we have to define some enablers in the form of accounting policies, accounting manuals, procedures, and so on and so forth. Reporting structure from subsidiary company to the parent company. That way we can have. Secondly, review your internal financial controls, not data as necessary. Thirdly, go for automation in terms of software, Excel macros, so on and so forth. And finally, the CFS is we all know that the financial statements is nothing but the success song of the organization. And a CA will only get his proper sleep if he knows that his balance sheet has tallied in the way that he wants it. Well, my dear friends, I have some good news for you. The CA will be able to sleep in a very nice manner because he'll have to tally more than one balance sheet because of consolidated financial statements. So with this, we welcome consolidated financial statements for the company and therefore better shareholder transparency will be achieved. Thanks a lot for your patience here.